Jennifer McGuinness, thank you so much for joining us. I've had a blast getting to know you over the last couple of months, and all the things that you're doing at Invigorate. Your reputation in the industry speaks for itself. I think our attendees are in for a treat. It's always awesome when we have somebody of your caliber that's going to give some information for our attendees, especially in markets like this, where there's a lot of confusion, a lot of questions being asked about how am I going to preserve my wealth, let alone grow it, but how do I at the very least be able to preserve it and navigate through these tough waters? So very excited for your presentation, and it's going to be well worth the wait, everybody. So Jennifer, without further ado, please take it away.
Well, I'm very happy that you now can all hear me, and thank you to Think Realty and the AMPL for the invitation. You know, I'm going to share a presentation today, and then we will go into some Q&A. I asked Kurt specifically if we could do that Q&A because I think there's a lot of questions that would be great to answer, and also conversations to be had. You know, for this, we are saying, how do you navigate a turbulent, market, and also candidly turbulent borrowers? As Kurt alluded, I'm the president of Invigorate Finance, and Invigorate Finance has multiple channels. I'm not going to spend too much time on this, but we are a correspondent aggregator. So we enter into contractual relationships with lenders to originate loans to our specifications, and we buy them. Away from that, we also have the asset management channel. In the asset management channel, we generally enter with industry participants in joint ventures, structured financial transactions, diligence engagements, servicing oversight and loss mitigation, triage opportunities, et cetera. And we are also approved by all 5 rating agencies as a third-party review due diligence firm for AAA-rated securitization. I think the best way to get this conversation started is, what kind of turbulent market are we navigating? And, maybe let's remove some of the misnomers of some of the allegations that we're seeing in the headlines. A great example is another 2008 housing crisis coming? My humble opinion is no. At the time in which the housing crisis happened, there was over a 12-month supply of homes available for sale. A significant number of homes were available for purchase at foreclosure sale at a significant discount, as properties in foreclosure were generally underwater versus what they owed. Loan balances outstanding were larger than the property values. Government intervention, be it on the resi space, the business purpose space, or even the commercial spaces, drove interest rates down, paused foreclosures, workout options, et cetera, and then a vast array of government implemented policies, programs, and let's call it additional regulation was added. Appraisal inflation at the time was there due to lack of regulation. As many of you know, appraisals across the different types of property types have been significantly changed. Error compliance is a good example, wherein a lender can no longer call an appraiser and say, hey, I need this value to be $450,000. They actually do it at an arm's length through an AMC. Underwater home prices also led to strategic default, and sadly, many of the government programs also precipitated additional strategic default. Fast forward to 2023, in July of 2022, there was over a 10-month supply of homes available for sale. In a healthy market, you generally see 6 to 7 months of supply. In March of 2023, not even a year later, we're back at a 7.6 month supply. This is the beginning of the equalization, and note, it's not an increase. And this is publicly available data that is actually published by Fed regularly. Rent prices have continued to increase. Initially from 2021 to 22 was up 14% year over year. And between June of 2022 and May of 23 have risen another 5.8 and 8.4% respectively. In addition, we're seeing an increase still in home building permits from builders. And, while this is positive and, the economists and forecasters will point to it, builders have generally been underbuilding for the last decade. So it's going to take them another 4 or 5 years to catch up. Single family estimates at the end of last year were we would see about 818,000 additional building permits for single family, it actually came in slightly higher. Now you are going to see metro or area specific adjustments on that. One of the key things that was focused on is, will we see a significant decline of building permits in the South? And where a lot of guys were talking about a 20% plus, we saw 11. So there's a lot to be said right now on fundamentals. As you guys know, low borrowing costs, introduced, were there basically to insulate the economy. And it brought about generally a 35% rise in home prices over the past 2 years. And we have begun to see that equalize, not completely, but closer to pre-COVID levels, but we're not there yet. Home prices, which blows everybody's mind, are not part of the inflation-based indexes tracked by the Fed. They do feed into other factors, such as rents, but they were actually removed from the CPI index in 1983. And instead, the CPI uses what's called an owner equivalent rent calculation. So they're not technically 100% correlated. Big ticket, interesting facts. Foreclosure activity continues to stabilize and even correct itself in 2023, with April showing a 10% decrease in overall activity after a 20% increase in March. And that was recently reported by Atom Data. 3.56% delinquency rate for 1 to 4 unit residences. If you look at the headlines, guys, that is the second lowest rate ever reported in the Mortgage Bankers Association data. 90% of the borrowers in active foreclosure today have positive equity, and over 20% of them sit in a 45 to 50% equity position. Based on this, many foreclosures are going to result in home sales or multi-unit home sales, rather than foreclosure auctions, leading to less distressed real estate for purchase. When you think about that, I sit at conferences regularly and on panels, and I sit across the table from many guys that say to me, and girls, interest rates like this have never been seen before. That's not actually true. You just have to be old enough to remember. So the last time mortgage rates rose this fast was in 1994. It was the last time a one-time 75 basis point increase occurred. And how many have we seen now? I think the Fed with their last 25 BIP increase has signaled that we're probably not going to see that happen at every Fed announcement going forward, but we'll continue to track that because, as many of you market participants know, that can change each and every day. In addition, while many of the economists and Wall Street research teams predict a decrease in home sales again, they are much more conservative as it pertains to home sales and home value. The market, however, is very different since 1994. In 2022, record low housing stock, higher household savings, and a job market where there was approximately 1.5 jobs available for every person looking. Not to mention the additional mobile or remote nature of today's worker are creating fundamentals that could materially impact many forecasts. 2023 has shown this, and we're watching to see what's going to happen. So when you think about the remote nature and mobile nature of work today, you have to think about the fact that people in a hybrid role or in a remote role could really be working from anywhere and take a job in any state or any nation. That's something that has not yet really been taken into consideration in forecasts, models, et cetera, because there's not something to benchmark it to. I'm receiving a comment that you may or may not be able to see the deck that I'm sharing. Kurt, can you confirm that people can see what I'm sharing on the screen? Okay, we're going to hope that you can. The sale of homes that have been previously owned were at a 2-year low, and we've begun to see list price reductions on homes for sale, as well as seller concessions due to higher rates. Now, does that mean that we are in a status where we're going to see material value decline? No, not necessarily. I think we've seen a very large correlation to the seller concession. And, that's not odd in a higher rate environment, guys. There's housing data shows a correlation between home price appreciation and mortgage rates. While still strongly correlated, they've been decreasing the past 20 years, and mortgage applications were down as well. Record low inventory over the past couple of years also means something else that you don't always see, and it's that there's plenty of pent-up demand, especially with millennials, ready to set up a home, whose share of purchases have begun to grow. Today, the average age of the first-time home buyer is actually a little older at 33 years old, and I believe we will see household formation numbers increase dramatically over the course of the next 24 months, as in my opinion, they were dramatically underreported during the pandemic. I'm going to stop sharing and reshare one more time to make sure that everybody can see what I'm sharing on the screen, because again, I've gotten more than one note that says that you cannot see what I am sharing. So I am going to share again. Hopefully everybody can now see what I'm sharing, more so.
It looks like you're sharing a Zoom screen that says, "Thank you for attending the webinar."
Yes, very strangely, I saw that. Let's try this again. I'm on the right screen share. See if we can make it work again. All right. You should see a deck in front of you. Kurt, do we have it now?
I see where it says continuation. Last time mortgage rates rose this fast was 1994.
Yep. So guys, there are slides that went with what I was saying. I have no idea why some of you couldn't see it, but these are the things that we just spoke about. And what I want to do at this point is I want to show you some of the things that we're seeing in the market. Stuff that, reasons why we believe that asset management and dynamic asset management is really the core to being able to manage your portfolio. Like I said, I think many people are so quick to say, we're going to be in a large-based recession, a housing crisis. Investments are going to go down, et cetera, but that doesn't need to be the case. So what we're going to do now is we're going to jump into some of what Invigorate Asset Management does. Kurt, I'm guessing we're going to open it up for questions at the end, but just wanted to then jump into some case studies and things as to certain things that you can do to really enhance the value of your portfolio, whether you're holding mortgage or real estate assets, whether you're an aggregator, a securitizer, a financing agent, et cetera, warehouse lender. In order to be able to achieve asset management in a robust way, you have to be able to actually pivot accordingly to address each market scenario and each facet of what it takes. Due diligence and acquisition based for an investor who buys property is extremely important. For a lender who originates a loan and relies on the secondary market in order to buy those loans. Your due diligence is really key. The manner in which you structure your financing is also important. Are you a lender or an aggregator of hard assets that only has short duration financing? When the market starts to change on you, you need that longer dwell period or term financing in order to take advantage of being able to equalize what could be a loss when the market rebounds. Servicing oversight and surveillance. All of your assets need to be managed and managed accordingly. Servicers, there are special servicers out there, but there are also payment collection servicers. What happens when these loans go delinquent? What happens if a breach of rep and warrant were to come into play? How do you source? How do you sell? How do you structure your assets? They're all very important questions, and the analytics, the modeling, and the details that go behind that. If you end up owning property post foreclosure as a lender, the goal of a lender is never to own a house. The goal of the lender is to have the borrowers pay for the duration. That's modeled on an asset and actually collect the cash flow. So how do you work with borrowers in order to provide the borrower benefit that's necessary, but also offset any possible loss? The reality with new appraisal methods, if you do good diligence on your appraisals, you shouldn't suffer a loss in the market today by virtue of where home prices sit. But if you're over-pregnant or over-leveraged on an asset, from a financing perspective, without sufficient diligence being done, or other risk-based issues, be it a rental property, a primary residence, et cetera, you could be signing up for a loss on day one. You know, Invigorate's team has a ridiculous amount of experience in a good way. You know, everyone from, you know, my credit team with an average tenure of experience of over 25 years. I have sat in the seat of investment banks, hedge funds, REITs, the lender, an asset manager, and multiple aggregators. And being able to look at assets in a multidimensional way and say, this will work for this counterparty, but not that. And be able to navigate those solution sets are important. Aaron, who runs our asset management division, has over 20 years of experience in TPR and due diligence. Chris, who runs our loan operations, again, over 20 years of experience in ops, but also diligence. Beverly Gentry on our credit diligence, 40 years of credit experience, and has done pretty much every lending product, and was also an expert witness. So it gives you just some level of understanding. And Nancy, who runs our QC perspective, you know, 20 years of experience and has done everything from work with the OCC to retail correspondent, et cetera, aggregation. Why is it important to have the approval of the rating agency when you are a securitization diligence related company? Because you need to know that you're meeting the methods that they're looking to strive from an outcome perspective. Diligence is prescriptive, but it also drives what will be the subordination level of your securitization. But that's not all that Invigorate is. As an asset manager, we also add additional value. We're going to go through some examples of those value adds and how to abate certain risks. There's only some samples here, guys, but when we open it up for Q&A, please ask any question that you'd like. We'll be happy to answer it. If we can't answer it on the fly, sitting here, I will come back to you with an answer. Business purpose loans, debt service coverage ratio assets, cross-collateralized collateral. There are a lot of things to take into consideration when you're lending on these assets. Many of these assets are securitized in concert with consumer-facing non-QM, as an example, and have to continue to meet REMIC eligibility. In order to do that, many people don't realize that it's not only an at-origination test, it's also at the time in which the assets are contributed to the bonds, and if one or more of these assets is released from that cross-collateralized asset, making sure that the servicer is doing the right thing not to blow up your 125% LTV test, okay? A lot of people don't realize that custodians do not automatically do cross-collateralized collateral review. We had to, for our own business as an example, create custom reporting with our custodians in order to ensure that we really were getting proper exception-based reporting. Do we really have all of the notes and collateral documentation that's necessary to have or own our collateral and be able to effectuate outcomes with it? We've seen the rise lately of, you know, the P&L loans, wherein you're seeing a lot more self-employed borrowers or self-prepared P&L statements, non-CPA or with CPA letters. And there are things that are being missed or not considered fully that many diligence and asset management and lenders candidly miss. A great example is work visas for self-employed or other types of borrowers. You know, in this example, you had a work visa that was actually expired at the time in which the loan was originated. There's only a 180-day grace period. At origination, this borrower only had 70 days left in the grace period. The income that was used to underwrite this loan 70 days later was no good until 292 days post the origination of this loan, which means that for 90, 100, 112 days, this borrower didn't have valid income to support the loan in the United States. Okay, these are real features and things that need to be watched. Appraisals. You remember how I said earlier that when you are originating a loan, be it an investment property, a primary residence, a multi-family building, you want to make sure that what you're providing the debt for the borrower on is what the use really is. This loan, as an example, was originated as a primary residence. What's interesting about it is if you actually look at the pictures from the appraisal, it actually looks more like a business. You have more of what looks like a waiting room. Every bathroom in the residence is enabled with handicapped equipment. Well, at the time of origination, not only was this not a primary residence, although it was originated, but it was actually a senior living residential home. And on the borrower's 1003, she was very clear that that was the business she was in. In the actual data verifications and fraud reports, you saw the flags, but the lender still originated the asset as a primary residence. Now, I'm going to tell you that another diligence company gave this a A grade for rating agency standards for securitization, when in fact, this loan fails guidelines based on collateral, amongst other things that we're not going to discuss on this particular call. A picture is worth 1,000 words, and you would be shocked by how many lenders, diligence agents, asset managers, and servicers do not look at the pictures in their appraisal. And here, you're going to see a property that, quite frankly, is a hazard. There are unlockable bars on multiple windows. You can't get out. There were ordinances and requirements for safety rolled out in the market quite some time ago. This appraisal was completed as is. If this property caught fire, this lower level is not getting out. In addition, the borrower on this loan applied for a primary residence loan, also as a single individual with no children. And what you're going to see in this appraisal is this is a bedroom. This is actually a makeshift kitchen. Additionally, you're going to see a bathroom that's talking about occupant use and cleaning up after yourselves from a boarding perspective. They're actually renting out everything in this building, including the unfinished basement second view. And here is yet another kitchen. Collateral is key to a market such as this, guys, when navigating if you're going to take losses. It's important that you look into these details. How about the appraisal where comp 3 literally indicates number 3, which has since been torn down? And no joke, on the next page of the appraisal is the torn down property with the green fence surrounding it. But yet they're still using it as a good comp for a $1.3 million sales price. That's not what appraisal is supposed to be. This should have been thrown out. The appraisers should have had to redo this appraisal. But let's assume that we got all of these things right. And now, as a lender, an aggregator, a bank trading desk, a REIT, a hedge fund, a real estate investor, you're holding assets that may not be at a market rate today. What do? Well, term financing facilities are available. And no, you do not need to be a money center bank to be able to reap the benefit of getting this type of financing. If you have loans on balance sheet that are not at market level rates, you can do an 18 to 24 month term facility. And when you believe that rates will stabilize and possibly decrease, If you believe the statements of the Fed and their latest, announcements, in theory, it should start to truly equalize and decrease at some point in 2024. So the question on loan assets is, should you lose 20 plus points selling these loans today? My humble opinion is no. There are multiple ways to triage through your assets that can return not only a benefit for you as a market stakeholder, but also the borrowers. Away from that, let's talk about the rise of the repurchase claim. Many aggregators have decided the way that they're going to triage through their portfolio is just put all the loans back to the lenders. Well, just because a loan is put back to a lender that sold that loan, are they actually breached? The majority of the time, the answer is no. So you have to be empowered to defend these claims accordingly, be it a money center aggregator, be it a private aggregator that acquires loans, be it the GSEs. Know what your allowances are and don't waste your rebuttal timelines with the GSEs. Housing Wire put out an article, this week as an example, $4 billion in assets have been breached to underlying lenders across the GSEs, many of which have already been resolved. Where are those loans? Let's fix them and make them cash flowing and make money for you instead of losing money. Hospital financing is available. For those of you that have been in the market as long as I have, and even longer possibly, you remember a time where you could finance a component of your repurchase risk. You can do that today. You just need to know how. Invigorate Asset Management partners with warehouse lines to do just that, as well as the term portfolio financing. We also do the triage on these assets, know how to fix them, and also do breach defense away from a vast array of other things. When you think about that and you couple the asset manager with an entity that can also acquire assets, we now have multidimensional opportunity to work out your loans together. When you put those solutions into one business, you now have a multidimensional partner. If I can't buy one of the loans that you originated to our specifications because you messed it up, I could sell out of that loan in my asset management division for you. And we specialize in business purpose and non-QM assets, DSCR, bridge, fix and flip, ground up construction, and also first lien, non-QM, jumbo, and shortly second lien products. So don't think that there are not solutions. There are. I'll give you an example. We partnered with a warehouse line that was stuck with many loans from defunct lending institutions. Not only were we able to sell those loans, we were able to structure financing and actually not only make that warehouse lender whole, but also decrease the exposure of what could be going back to those now defunct lenders. At the end of the day, the overall deal netted positive cash flow. And that's not the standard fire sale that you'll periodically see in the market. That's a structured deal that takes skill in order to effectuate it. Away from these opportunities, there's many other things that can be done, in order to abate risk and take, that risk almost completely off the table. Pre-close review, additional QC methods, additional testing on your assets, etc. These are just some of the things that we see day to day, right? But we see a lot more. And every strategy can be executed. You just have to determine what the structure is. With a little bit of creativity, knowledge, and partnership, you do not need to lose money in a market like this. Learn the details, partner with somebody that knows, and you will see that, in fact, you can actually make money on assets that you felt that you would lose. That's just a high-level presentation. I know we're running a little bit behind due to, our later start, But I would really love to open this up, Kurt, if you're open to it, for not only questions about some of the things that we discussed now, but also challenges that others may be experiencing as well. Is that okay with you?
Absolutely. And I would encourage anybody who's on here right now that has questions as it relates, especially to this market, because I know that was kind of the central theme of the presentation is how do you ensure that smooth landing in this market? But there are those tried and true methods that can work in any market. And I think, Jennifer, you touched on some of them. Ones in particular that I wrote down was the decades of experience that your team has across the board. And you kind of have all-in-one solutions. But something you touched on that I think is very important is when we're talking about strategies of making money and creativity, a lot of that comes down to who's got the knowledge, who is a good partner. And that ties right back into due diligence. When you're looking at due diligence, what to you would be the most crucial element of the due diligence? Is it the numbers of the deal, or is it the track record of those that are going to be partnering with you? Mine would be the latter, but I'm interested in your thoughts. When you look at due diligence, what do you consider to be the most important facet of that deal?
Look, I think experience is key, but I also think historical experience is key. I think we spend a lot of time seeing due diligence counterparties cropping up all over the market, technology that's allegedly going to save us from ourselves and, things like that. And I'm a fan of tech too. But what I would say is that, without actual market-based knowledge and historical knowledge of what happens in the market environment and knowing what to look for from a red flag perspective, you really can't know. I sat across the table from somebody recently at the SFIG conference, and they very seriously looked at me and said, "We have not seen rates like this ever in the mortgage market." But that's just not true, right? They weren't in the business then, but that doesn't mean that Google shouldn't be your friend, and you should know that there has been historical rates this high, right?
Right.
I think that that's important as well. And for some reason, my camera has stopped showing my face. I apologize for that. We've had some interesting tech stuff today. But no, I think it's knowledge, process, and the details. Data is also very important, and making sure that the data that you're looking at and confirming is actually correct.
I would agree with that. And I think that really lends itself back to the one of the key things is that knowledge. And events like this, events like Think Realty in Tampa, our sister company, American Association of Private Lenders, their conference, deal flow is one thing, but I think that especially in times like this, these are the places that you go find those successful investors, because there's a lot of doom and gloom. You just illustrated it, people saying that we've never had rates this historically low. And again, that's not true. They just may be going through their first cycle of that. So when I hear that you guys have decades, 3, 4, 5 decades of combined experience across your team, it would stand to reason you guys have probably seen up markets, down markets, and everything in between. We saw the 08 to 2010. We saw, back in the 80s, the stock market collapsing. We even saw COVID, the pandemic being new for everybody. And I think as we come out of that in 2023, you're seeing the companies like yourselves that are still solvent, that are still thriving. And because of good decision-making 5 years ago, it's allowed you to still be successful today. And I think that's something that can be understated, is that some people have a sense of what's coming. There's always the unknown, but that adaptability and being ahead of the curve, I think, is key. And you've touched on that several times with the experience that you guys have. One of the question from an anonymous attendee, does the uncertainty feel in this market, does it feel better, worse, or similar to previous downturns or previous questionable times? I think is what the question is.
I think it's different, right? I don't know if we would go with better or worse. It's definitely not the same, right? And I think that so much has been done from a regulatory perspective that you're not necessarily going to be seeing a repeat of history, but then overregulation can also make it difficult, candidly, to bounce back more quickly. I mean, anybody that was in the market during, the housing crisis, as an example, you knew that if we would have allowed the borrowers that were in default to actually go through foreclosure, instead of prolonging what turned out to be almost a decades-long crisis, we probably would have seen the market equalize much more quickly. So one of the things that, I think is positive about where we sit today is, we have not seen that because delinquency level is so low, right? The one thing that I think, is important though, in nuances or details is in order to know how that should feel, you really need to have the skill set to understand what I lovingly call the happy and not so happy side of mortgages. I can make a case candidly for why every loan should and should not be originated at the same time, right? The knowledge really comes from, knowing what risk-based decisions could repeat on you and cause, an impact to the asset value. And I think that that's a very important key component to where we're sitting today.
I couldn't agree more. I would echo those sentiments as well. Question from an attendee is, in terms of preferred markets, segments of the country, to invest in, do you see some that are performing better than others? And do those even break down into suburban, secondary, or even tertiary markets? Essentially, where are the good deals?
Well, look, I think it depends on what kind of good deal, right? Obviously, certain tertiary markets actually provide for a fabulous rental yield, right? Obviously the rise of the short-term rental has become a big thing, even more so now with, people being able to work remote. There are different sectors, people started to deploy tons of money as an example into RVs. Why? Because people are upwardly mobile. It was one of the biggest sellers during COVID itself. RV sales, for example, had never seen levels like that. Look, I think a good rule of thumb is major MSAs in secondary markets, but don't oversaturate in certain markets. And if your portfolio starts to look like it's tracking over 50+% to certain states, it's a good rule of thumb to equalize that to a better blended national footprint. It's one of the reasons why, for example, aggregators have LLPA adjustments in certain states to be able to control for those additional saturation risks, right? But
Right.
Good rule of thumb is not every asset should be in the same place. A well-balanced portfolio is a less risky portfolio. But in proper tertiary markets, if you were oversaturated, you will still win. So it really depends on what strategy we're looking to effectuate.
Well, and you touched on some key things, and it takes me back in my real estate career when I was in self-storage, and secondary and tertiary markets were our biggest, money makers in terms of returns for our investors, but it also allowed us for economies of scale, which definitely help you in any kind of market, but in particular down markets. Anytime you can get some economies of scale and get some more friendly financing, that's always a big driver as well. And you can do that really in any asset class. We just happen to be doing it in self-storage. But I think adding on to what you're saying, economies of scale, that opportunity is always there as well to help you grow and accelerate that portfolio as well, while being diversified as well. Because that's always the key is you can have 10 investments over here doing great, but if you have that one over here that's not performing as well, we've got those 10 over there that help balance that out and help you have that soft landing, that smooth landing that you've illustrated both in the title and through this presentation. Any other questions from the attendees? Please ask them now. I mean, Jennifer has been very giving with her time and very informative. Do me a favor, Jennifer, what is the best way to reach you? I'm going to put this in the chat for people so that they can reach out to you directly. Maybe some are a little bit shy in a public forum if they want to have more one-on-one. What's the best way to get in touch with the team and Invigorate?
So you can actually email me directly. In concert with this Think Realty podcast and, also the AAPL, I'm going to give the attendees of this conference my direct email address. I just put it in the chat for you. If you have a question, you want to talk through a market, you find another leader that's going to hand that out to an entire audience. I want you to ask me the questions. We want to help
that's
you.
Very impressive and very
that
giving.
is,
I think we talk about experience, we talk about knowledge, we talk about partnerships, we talk about just the dialogue. I would echo the sentiments. I don't know a lot of CEOs, presidents, leaders of organizations that will say directly, come one, come all, I'm here to help you. So that's maybe the biggest takeaway of this whole thing is not only have you been very successful, but you're also incredibly giving. So my challenge to all of our attendees, reach out to Jennifer. I mean, it could make the difference in this year, the next 10 years of your investing career with some of the information that she has available to you. So again, guys, thank you so much for your time today. Jennifer, thank you so much. Look forward to seeing you in person. And guys, again, come to our Tampa conference. Jennifer will be there. Get to shake her hand, get to dig in a little bit deeper with her on all things real estate, on all things due diligence, and all things market specific. I can't say thank you enough, Jennifer, for your time. It's a great presentation. Great to have you on. And attendees, wherever you are, please reach out to Jennifer directly. That email is there. We'll start repurposing this in the next couple of days, sharing it out there on YouTube and our various social media channels. So if you didn't get to attend, or there's something that maybe you didn't get to write down, go to our YouTube channel tomorrow. This presentation will be live tomorrow. So thank you all. Thank you all so much for being on here today. Thank you, Jennifer. Thank you for bearing with us with the technical difficulties at the start. I know this was a great presentation that you all got a lot out of. So with that, have a great day. Have a great week. Reach out to Jennifer. And again, go to thinkrealty.com for all things Tampa and all things membership. Learn more about how we help investors all over the country as well. Thank you all. Talk to you all very soon.
Thanks, everybody. Bye.